we are now going to discuss on who will be the next winner in the market. So as we know, the winners of the market as of now has the power. However, till how long? It has always been amazing to see that not only do winners rotate annually, but that the leaders and the laggards from one bull market to the next rotate as well. But why does this happen? And who will be the next winner? What does the market anticipate? Let's dive into this with the market expert, Mr. Aashish B. Somaiyaa, Chief Executive Officer at WhiteOak Capital Asset Management Limited. WhiteOak Capital has operations across India, Singapore, Mauritius, UK, and Switzerland. WhiteOak has attracted among the largest foreign portfolio investment inflows into India over the last 3 years. WhiteOak Group entities collectively have an AUM of 5.7 billion USD as of 31st March 2023. Let me also take a moment to introduce Mr. Ashish. Mr. Ashish is responsible for strategizing, growing, and managing the operations of WhiteOak Capital, a highly differentiated investment management firm. Now I'm handing over the mic to Mr. Vikas Agrawal, who will in turn be handing over the mic to Mr. Ashish. Over to you, sir.
Yeah, thank you, Pragya. Aashish, can you hear me?
Yes. Hi, Vikas, very clearly.
Okay, yeah. So firstly, thank you, Aashish, for accepting our request. I know you're always very, very passionate about educating and empowering the investor community as a whole, and you've done many roadshows in last decade or so in pan-India level. So, this time we picked up this topic, who is going to be the winner. And, well, it's very difficult to identify, but then we thought who would be the better person than you to come and speak about that, because you've seen multiple cycles in your career. We saw that there was a time when infrastructure used to be the favorite darlings of the industry, and those had its own run sort of during 2007 and 8 times, and we saw FMCG stock picking up and many more. So idea is that if you can spare some time and talking about this at an organization level, what's your views, and then you give us another 5 minutes. At the end of the presentation, I'll be asking you a few questions on behalf of our investors. So over to you, Aashish. Thank you.
Thank you. So, thank you very much, Vikas, and the entire team for inviting me here. It's a pleasure always to speak to you and obviously your esteemed clients and partners. I think that Pragya laid out the context quite well. We all know that if you're an investment advisor or if you're an investor, one of the biggest problems or one of the biggest challenges for any investor or investment advisor is that how to pick the right fund manager, or how to pick the best fund manager. Of course, one notion is that you should look for the right fund manager, whereas everybody looks for the best fund manager. That's a different story altogether. But the challenge is that people would love to invest with the best performer. But the biggest problem is, like Pragya mentioned in her opening remarks, that every year or 2 years the best performer changes, and that is where the whole question comes, like you mentioned, that winners rotate. Correct. And while the topic would have been winners rotate, you have very smartly made it who will be the next winner to put me into a spot of trouble. The reality is that winners rotate. Correct. But human beings find it very, very difficult to associate with this whole idea. Let me step back and tell you that, for example, what is the biggest challenge for human beings in operating or in negotiating in the stock market? The challenge is that human beings like very, very clear answers. We are very deterministic. We like to know specific outcomes, right? And we love certainty. So that is the biggest issue. Whereas if you see stock markets are not amenable to certainty. Stock markets are not amenable to judgments or conclusions. In the stock market, something which today might look abjectly wrong, 2 or 3 years later, that will look like absolutely perfect in terms of context. So what I've seen over the number of years, my 23, 24 years that I've been associated with the mutual fund industry or the PMS AIF industry, what I have seen is that human beings love to get certainty. Human beings love to get deterministic answers. But what matters in the stock market is only context and perspective. In a certain context and certain perspective, something may be right. It may work very, very well. In a certain context and certain perspective, something may not work out and it may be very, very wrong. And why just stock market? You look at the economy. In 2019, our GDP growth was 3.7%, and fiscal deficit was only 3.5%. But despite having 3.7% GDP growth, which is pathetic, our top priority was to cut deficit. It might sound odd to you, but that was because the US was booming at that time. And you cut to 2021, 22, our deficit was minus 7.6%. But we didn't discuss deficit. Our priority was growth. Why? Because the whole world was down in the dumps. So that is an example that, in stock markets, context and perspective, in the economy also, context and perspective matters. There are no absolutely right or absolutely wrong answers. And that is what is said in Bhagavad Gita also, that in a certain context, it may be right to even fight a war with your cousins. You and me don't fight wars or don't even argue with our cousins, usually speaking. But in a certain context, wars were fought where cousins were standing against each other. So there are many things in life where context and perspective is important, and you will not get deterministic answers. Like, for example, where is this topic of winners rooted? Where is it coming from? Because generally people want to know that which sector will work this year, which asset class will work. Should I be in equity? Should I be in debt? Should I be in a growth fund? Should I be in a value fund? Should I be in a large cap fund? Should I be in a small cap fund? Right? So when it comes to asset classes, when it comes to style of investment management, when it comes to sectors, philosophies, for everything we want deterministic answers. That, okay, sir, this year, this is what will work. Why don't you buy this? And generally what happens, people end up buying what has done well in the last 1 year or in the last 2 years. And what will happen is, invariably, you buy something which has worked in the last 1 or 2 years, you enter that, and in the next 1 or 2 years, something else itself starts to fire up. There is a very common statement, I have no disrespect or no harm I mean for animals at all. But there is a proverb in English which says that you got to shoot where the rabbit will be. You cannot, if you want to shoot a rabbit, you cannot shoot where the rabbit is. You have to anticipate where the rabbit will be, and you have to shoot where the rabbit will be. But question is, can you really do that? So when you're investing, which asset class is the right asset class to be in? Which style of investment will work well? Which sector will work well? People generally jump in and buy what has done well in the past. But if you think in terms of shooting where the rabbit will be, can you buy what is going to work in the future? And I think, for everything, like for many things in life, we human beings, we like to look for answers which are black or white. We want to slot something. This is good, this is bad. This will happen, this will not happen. This is black, this is white. The reality is that whether it is life or the economy or the stock markets, everything is a spectrum of gray, correct? There are no black or white. It's only shades of gray. So I think even, let's say, for example, when we do financial planning, we tell people that you should divide your assets based on risk tolerance and return expectations. But what do people do? They want to know, boss, don't give me all this. You tell me whether to, right now, is it time to buy debt or is it time to go overweight in equity, right? The answers are always probabilistic. For success as an investor, for success in the stock market, all the answers are probabilistic, whereas human beings want to get deterministic. So that's the whole prelude or the whole background. I think for success, you need to be probabilistic, but human beings by nature love to be deterministic. And life, economy, stock markets is not amenable to deterministic thinking. You will thrive only if you have probabilistic thinking. So with that, just to put up one particular chart, I'm going to put up now 2 or 3 different charts. One is about asset classes, one is about sectors, one is about styles of investing, and see and tell you how winners have rotated. And then, who will be the next winner was your question. So then let's try to also understand how that would play out. So I'm putting up the, first chart that I want to show to you, Vikas, out here. And see what you can see here, Vikas. You can see the screen, Vikas?
Not yet. Mandvi is working on that. Yeah, sure. I can see that.
Yeah, so this was recently, not made by me or by WhiteOak. This is, I just downloaded it from the internet. This was recently released in the...
Yeah, zoom in this a little bit, Aashish. Yeah, thank you.
Yeah, is it clearer?
Thank you.
Yeah. So
Yes, sir.
because this is not made by me. As you can see, it is from Mint newspaper. Our friends Neil, Neil and Josh and all, they prepared this. It came in the paper few days back. Now, what does this actually tell you? Human beings are trying to figure out that all investors are trying to figure out whether this is the year to buy gold, whether this is the year to buy large cap, whether this is the year to buy treasury bills. Should you buy debt? Should you buy US equity? Now, for example, look at it this way. In recent times, everybody has been thinking that taxation has changed. Now international funds will be treated as if they are debt funds. So we should not invest in international. Now if you see this chart, you will find many, and you should not invest in gold, by the way, because gold is also. Now if you take, first of all, taxation is not the key point. What does this chart tell you? Take FY16, when gold was up 10%, Nifty was down 8%, right? You take FY14, S&P did 31% and Nifty did 19%. So first of all, tax is not the consideration. Just because you want to avoid tax, you cannot give up the gains. I think that is something which is commonsensical. So one thing this chart tells you is that the winner keeps rotating. Which asset class will do well it will keep changing. In some years, S&P 500 is best performer. In quite a few years, small cap has done well. In certain years, gold has done well. But the point is that if you try to think that which asset will do well, you're not going to be able to put all your money there. And if you think that what did well last year is going to do well next year, that also doesn't really help. So when it comes to asset classes, you can clearly see that the best performing asset class keeps on rotating. So this is something when you look at asset class. Now moving on, I'm putting up another slide out here, moving into my presentation. Now instead of asset classes, Vikas, if you were to look at sectors, right? You can see the screen now, Vikas. Is the screen visible now? Now, even when you look at sectors, right, you can clearly see that the best performing sector changes practically each and every year. And by the way, the rotation is so much. Now you look at, for example, in 21-22, the best performing was utilities, correct? But in 21-22, when utilities was best performer, in 2020 it was second quartile. In 2019 it was close to the bottom, and for many years it was not a top performer at all. In 2019, for instance, real estate was the best performer, but then you see many previous years it was nowhere there. So what happens is that in 2020, healthcare was the best performer, but in the previous years it was always maybe low, or even actually if you see even bottom quartile. So what is the key thing to keep in mind? That even whether you look at asset classes, the best performing asset class changes literally every year. If you look at sectors, clearly you can see that the best performing sector keeps changing year on year. So there's nothing like buying the best sector, right? And you cannot even forecast. Like this year, for instance, sorry, can you hear me, Vikas? Yeah, so if you see, for example, you try to forecast based on this chart, what is going to be the next best performing sector going forward? Again, it's not possible. I think somebody's talking in between. Can we? Yeah. So if you really look at going back to the sectoral slide, what you will find actually, going back to the sectoral slide, and I'm putting it back up here again, what you will find is that every year the best performing sector changes. And if you were to think that, like defense or utilities, if you were to think that we should find the best ideas in utilities or find the best ideas in utilities based on this chart, then it's quite likely that you are going to be disappointed. So in the long term, by the way, the best performing sector is IT services. But if you see the last 4 to 5 years, IT services has not been the top performer. In fact, in some of the years, it has been barely top third or fourth or fifth. So we've seen asset classes, they rotate every year. We've seen sectors, they rotate every year. And now let's move to styles of investing. You know that, most managers, they prefer to have a particular style. So if you see in 2022, there was a lot of discussion about this. In 2022, by a mile, the best performing style was value. Correct. In previous years, it was defensive or alpha related strategies. So you will find that even if you look at asset class, even if you look at sector, and even if you look at style, the best performer is going to keep changing. And why does this happen? Why is it that asset classes, sectors, styles, why is it that they keep rotating? The reason is very simple. It has got entirely to do with macro developments. If you look at 2022, for instance, everybody who had oil, metal, energy, utilities, PSUs in their portfolio, they've done extremely well. And the people who have high governance, growth-oriented portfolios, or people who have more small and mid-cap versus large cap, they may have actually suffered to some extent. Now, the point is that in 2022, why is it that suddenly value bounced and PSUs really shot up? And by the way, the guys who have done very well in 2022, you can see clearly that for the previous 4, 5, 6 years, they were actually not amongst the top performers. So what happened in 2022? At the beginning of the year, there was a war. Right. In 2021, PSUs did well because the finance minister announced that, forget disinvestment, we'll privatize everything. Reality is that there was no disinvestment, there was no privatization other than Air India, which means in reality, the rally in PSU should not have lasted. But when 2022 came, it started with a war. And because oil, metal, energy, utilities, a lot of these sectors have a preponderance of PSUs, it really shot up. So when macros change, styles and sectors which are in or out of favor are going to change. But the key point about macros is that macros cannot be forecasted. And even more important is that even if you forecast macros, you cannot forecast how the market will react. So macros cannot be forecasted. Of course, you couldn't forecast the COVID pandemic. You couldn't forecast that US will go to 6% interest rate. You couldn't forecast that you'll have $45-50 billion of outflow. You couldn't forecast that there'll be a war. And by the way, in July 2021, if somebody even told you that there will be a war, oil will go to 125, rupee will go to 83, US will have series of rate hikes, we will have $40-50 billion of outflow, then in July 2021, you would have made your equity portfolio zero. But what happened? You couldn't have forecasted these macros. Even if you forecasted the macros, you would have made your portfolio zero. But even if you made your portfolio zero, you would come back in 23 and find that the market hardly fell. Right. In Feb 2020, if somebody told you there's going to be a COVID pandemic, you would make your portfolio zero, but you will regret it in 5-6 months because market started making new highs. So 2 or 3 things, just to sum up what I have said so far, whether it is asset classes, whether it is sectors, or it is fund management styles, they will keep rotating. When do they rotate? They rotate when macros change. But what is the problem? It's very difficult to forecast macros. And what compounds this problem further? That even if you forecast macros, it is difficult to forecast how the market will react to these macros. This is the reason why winners keep rotating. Now the key point is that how should we manage money to tide over this entire issue of winners rotating? Because like you must have gathered till now, whatever I said, you can clearly see that winners do rotate. Why do they rotate? And what can you do? Right? I think all of these things are challenging. So what is the answer for this? What actually is the panacea for these kind of challenges? I think one of the learnings that we have at WhiteOak is that if you can run a portfolio which is balanced for all types of macro events. So instead of trying to bet whether growth will be good or value will be good, you run a blend portfolio. Instead of trying to bet whether you should be in large cap, mid cap, or small cap, you run a multi-cap portfolio. Instead of trying to bet whether rupee will go up or rupee will go down, you try to ensure that your portfolio has some neutrality towards domestics versus exports. If you, instead of trying to figure whether interest rates will go up or down, you have some balance of defensives versus cyclicals. So I think the key point is that a lot of times, if you have a narrow portfolio, if you have a narrow portfolio which is leaning heavily on some asset class, if you have a narrow portfolio which is leaning heavily on some style, if you have a narrow portfolio which is leaning heavily on a couple of sectors, what will happen is when the macros are favorable to your style or sector, you will have outsized performance. And when the macros turn into headwinds for your style or sector, that outsized performance will get into outsized underperformance. And this is what we normally call as winners rotate. So you will find that the guys who are number 1, number 2 become bottom, and the guys who are bottom become number 1, number 2. Now this is what happens, that when clients are exposed to extremes, they react emotionally. And when they react emotionally is when investment mistakes tend to happen. So let me share some experience of what we have seen in our journey at WhiteOak in the last few years. So as you alluded, Vikas, can you see the screen now?
Yeah, Manvi,
So as you alluded,
I can't see one.
yeah.
Yes, I can see it now.
So yes, thank you. So as you can see on the screen now, you can see that for sake of propriety, we have not put. And by the way, this is not to tell about WhiteOak's performance. This is more about how winners rotate. So pardon me for that. If you see what you will find is that for sake of propriety, we have not put all the PMS names. So what we put is PMS portfolio 1, 2, 3, 4, 5, 6, 7, 8, 9, 10, whatever. And these are all large sized PMSs, 2,000, 5,000, 10,000, 15,000 crores of assets. So what does it actually tell you? It tells you that, let us say you take 2017 when we started. 2017 when we started, somebody called portfolio number 2 was ahead of us. Next year they went to the bottom. Then they started rising. 2021 they were at the top. 2022 they were at the bottom, and 2023 they've again started at the top. Then you see portfolio number 1. It starts below, starts rising. 2020 it's middle. 2021 down. 2022 again up. So if you follow this whole trajectory, what you will find is that in any given year, there are some people who will be ahead, some people who will be behind. But what are we trying to do? We are trying to run a broad portfolio so that in our good years, we are in the top. But in our worst of years, like 2022 was not a good year for us at all, because we had focus on high governance. We didn't have oil, metal, commodities. We had small and mid cap 2x the weight of the benchmark. So because of series of headwinds, last year was not good for us. This year we are ahead of benchmark, but still we are in the middle. So what it shows you is that, and by the way, if you take April, we will be well ahead because big traction in performance after April. But the key point I'm trying to highlight is not our performance. Key point I'm trying to highlight is that if you want to overcome this phenomenon of winners rotating, then what you need to do is manage in a way that in your good years, you're top quartile, but in the worst of years, you don't just shoot to the bottom because you don't want to expose people to extremes. If you see in a different way, what you will find is that every year, the people who are ahead of, let us say, WhiteOak is a sample of a broad portfolio, which we call a balanced portfolio, which is neutralized for all this sector style and all these kind of things we try to balance. You will find that in any given year, somebody's ahead, somebody's behind. In different years, somebody who was ahead falls behind, and somebody who was behind who goes up. But what are we trying to do? Run a broad portfolio, try to be top quartile. That's the key essence. So I think, because the learning or what the message I want to share here is that winners will keep rotating. You will never be able to forecast who's the next winner. But the key point is to be in a portfolio which is which neutralizes the macros and focuses heavily on stock picking, because you will never be able to find the winner. The only thing what you will be able to do is if you can be consistently correct if you can be consistently correct instead of being occasionally brilliant. I think that is the key thing to watch for. So sorry for a long-winded monologue. Thank you for listening me out. If you have any questions, Vikas, I'm most happy to answer.
Thank you, Aashish, for enlightening us with your thought process. So the first question is, there are times when portfolio manager knows that the sector will not do well, but they still maintain the same weight. What's your views?
No, I think this goes against the basic thought process that it's not possible to forecast, because which sector will do well. If you ask me today, I might tell you that okay, there is too much bearishness. Valuations are very, very interesting. Pharma looks cheap. IT mid-cap IT looks cheap. Private sector banks look cheap. Urban consumption and consumer discretionary will bounce back, and that may reflect in my portfolio also possibly, right? But I think that despite me saying all this, doesn't mean that I should have zero weightage to industrials. Doesn't mean I should have zero weightage to domestic capex recovery. Because what will happen is that it is well known that in the best of sectors also there are pathetic companies, and in the worst of sectors also there are very good companies. You take an example for this same question I'm answering. In 2017-18, Vikas, pharma was a hated sector. Everybody was worried about US FDA. Everybody was worried, that where will the next hit come? So 2018 pharma was a hated sector. In 2018, NASSCOM used to say that IT will grow at barely 5% dollar growth rate. So these were hated sectors. But even if you compel yourself that, okay, look, I want to ultimately consistently I want to beat the benchmark, right? And I want to be consistently out there amongst the good performers, correct? So then you will say that, okay, in the index, this is how much IT and pharma is there. In our economy, this is the pharma and IT contribution. So even when it is a hated sector, definitely there will be some good companies who are outperforming significantly. So in 2018 and 2019-20, only pharma worked, and even IT did very, very well. But you couldn't have forecasted COVID. You couldn't have forecasted that rupee will depreciate so much. So then how do you end up having IT and pharma in your portfolio well in advance of its movement? Not by trying to forecast, but by working hard to say that I want to have a broad portfolio. Even if this sector looks headwinded from macro perspective, let me still find the best performers. So if you try to, because in 2017-18, your portfolio would have been fully domestic. NBFC, auto ancillary, that is what was flying. You would have had a domestic cyclical growth oriented portfolio in 2017-18. You would not have had IT or pharma. But how will you have IT and pharma is only if you think that, okay, my portfolio is too much domestic oriented. Let me look for something which is export oriented so that my portfolio gets balanced out. And this effect is nullified, but the return comes from the stock picking. So we should not be in the camp that in future only this sector will do well, because macros can change and your forecast can go wrong.
Next question is, if nobody knows where are we headed, then what do you mean by professional expertise?
Professional expertise is not in forecasting. It's not in forecasting. The best of guys who forecast go wrong. Professional expertise will be shown only if over a period of time, like I have shown in some of the slides, only if over a period of time we can do better than the benchmark, and only if we can identify some companies on a bottom-up basis. So for example, professional expertise can be shown if we have, say, 30 analysts who are covering 650 companies, and from time to time you find that we are with some Navin Florin, or we are with some let us say any pharma company well in advance, right? If you find that we are ahead with Persistent Systems or Coforge in 2018 or 2019, if you find that we are ahead with our picks in chemicals, for instance. So if you find that we are ahead, like right time increasing banking exposure. So the point is, all these things don't come from forecasting. It comes, so stock selection and portfolio construction, both things need to be done in order to be outperformer over a period of time. A lot of times what happens is that I mentioned right at the beginning of my commentary that human beings want certainty. They love to listen to people who sound very, very certain and very, very confident, because we feel comfortable when people give us certainty. But there is nothing called certainty. You may have expectations, but you have to prepare for eventualities also. So please don't believe anybody who says that their professional expertise is in forecasting macro events, or their professional expertise is in forecasting sectoral rotation. No, their professional expertise can only come in stock selection and portfolio construction, and over a period of time that should show them as a top quartile performer, or a person who beats the benchmark.
Last question, Aashish. I don't know if you're comfortable taking they're asking that which are the sectors that you think will do well going ahead in next 5 years?
So there is like I mentioned, we invest across every sector and every market cap. So that is our portfolio position. But with due respect, because there is a question on sectors, I can tell you 2-3 things. You are seeing clearly that in the next few years, we are going to have the largest pool of working age population. So what that means, it means that we have the biggest force of consumers and biggest consumer force and biggest labor force, right? The problem with the whole world is that the countries which are biggest economies and the countries which were contributing most to the growth of the world, they are aging and they are slowing down. So in the last 5 years, India's contribution has gone from barely 3-4% of world's incremental growth. We have contributed now 20% of the world's incremental growth. So we'll be biggest consumer force, biggest labor force, and we are going to attract a lot of investment into the country, right? As a result of all of these factors, not giving long answer, as a result of all of these factors, it is reasonable to say that from being a lower middle class country of $2,400 per capita income, we'll at least be a middle income, middle class country of $6,000-7,000 per capita income somewhere in the foreseeable future. World history shows that whenever a country goes from being lower middle class to middle class, the top priority of people is to plan for their future and to live better, to look better, to live better, and to plan for your future. So according to me, everything to do with discretionary consumption, everything to do with saving, investment, and insurance, I think these are going to be, there will always be cycles of undervaluation, overvaluation, good return, not so good return. But if you ask me, secular sectors over next 5 to 10 years, discretionary consumption and the whole saving, investing, wealth management, insurance, capital market industry, these are two things to really look at from a long range perspective.
All right, Aashish, with that, we'd like to conclude the session here. Thank you so much for sharing.
Thank you, everyone. Thank you.
And we look forward. Whenever we listen to you, you always leave some food for thought. So thank you.